Welcome to Taking Stock for the week ending the 28th of October 2022. I'm Kien, Trinh, and joining me today is our Equities Analyst, Daniel Ortisi, to stream to you all things share market. Well, Dan, it's approaching the end of the month and the AGM season hasn't been too bad, has it?
No, that's right, Kien. I think AGM season's been quite good, and a lot of our star stocks, especially in the retail sector, have actually performed a little bit better than what consensus expected. So, going to wrap it all up today, but looking forward to getting through it.
Yeah, thanks, Dan. But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and tables presented today shouldn't be relied upon as a guide for future performance. Well, it's been quite an eventful week for us and the markets. We also had Matt and Tim present at the ASA conference, just reminding investors about the importance of financial health in a rising interest rate environment, and also as we approach a slowing growth environment as well. But, looking at the third quarter reporting season in the US, that's been off to a decent start with around about 72% of the S&P 500 companies reporting better than expected earnings results. And not surprisingly, the pressure on profit margins have continued to be quite a key theme, driven by the high inflationary cost pressures. In fact, when you look at profit margins, they've declined by a fifth straight quarter in the US so far.
That's right, Kien, and that theme is also beginning to transpire here during our AGM season. Consensus earning estimates have held up relatively well, despite these inflationary cost pressures, and this is shown on screen with a chart of the All Ords Index compared to its forward earnings trend. During the week, ex-star stock Reliance Worldwide, which is a manufacturer of plumbing supplies, announced significant cost pressures, with profit margins falling by 27% over the September quarter. And Reliance Worldwide tends to be a pretty good barometer of global economic construction activity and household consumer spending, considering its products they use in the plumbing industry.
And margin pressures are not surprising, given that headline inflation jumped 1.8% in the September quarter and pushed the annualized CPI to 7.3%, above market expectations of 7%. And this was driven by housing construction, petrol prices, and also rising furniture costs. And businesses exposed to these areas of the market are vulnerable. So we are continuing to monitor our star stocks in these areas quite closely, especially stocks like James Hardie, CSR, and also homewares retailer Adairs.
That's right, Kien, and strong increases in grocery prices were also recorded over the quarter, which was consistent with what star income stock Coles said in their trading update, which revealed supermarket inflation running at around 7.1%. Despite higher prices of its goods, the company reported a 2.1% uplift in like-for-like supermarket sales for the quarter. In order to manage increasing cost pressures, the business is reassessing its capital spending program and engaging with suppliers to try and lock in lower prices on key items until January. What this should do is try help support its net profit margin in the near term, which should also translate to supporting its gross dividend yield of around 5.7%.
Yeah, and the higher inflation figures, it's led to banking analysts upgrading their forecast peak in the cash rate from around 3.1% to up to around 3.8, 3.9% for early 2023. So higher than expected interest rates tend to weigh on growth stocks, and we've seen this play out over the last 6 months. But in these instances, it could present those exciting opportunities for investors, especially if the outlook for these quality stocks remain intact. And the AGM, as you said, then provides investors with insight into the fundamentals, with numerous stocks reconfirming their earnings guidance, such as, for instance, CSL, Brambles, and even Net Wealth as well. Now, looking ahead, there is some evidence that inflationary cost pressures are expected to ease as well. The global supply chain pressures, they've decreased in September, marking its fifth month of declines. Meanwhile, here in Australia, you've got the producer price inflation, which really feeds into manufacturer and company activity, and that's shown signs of slowing down in recent months.
Yeah, that's right, Kien. And amongst the retailers in particular, we have not yet seen the effects of rising interest rates materialise on consumer spending, as both Super Retail Group and JB Hi-Fi reported double-digit like-for-like sales growth in the first 3 months of the financial year. Looking ahead at analyst forecasts, there appears to be sufficient free cash flow to provide some buffer to future dividend payments, and both are trading on a forward gross yield of around 8% with an unstretched payout ratio of only 65%. Now, as you mentioned, we will continue to monitor this sector, particularly how future interest rate rises could impact the upcoming Black Friday and Christmas holiday period. And our members should pay attention to their net profit margins and 3-month earning revisions on Stock Doctor to see how expectations are changing over time.
Yes, Dan, those net profit margins look, they do look pretty slim for the retailers, so we've got to pay attention to that. But let's now turn our attention to some other Star stock highlights this week. Borderline growth in Star income stock, ANZ Bank. They delivered quite a bumper increase in cash earnings of about 5% over financial year 22. And the bank benefited from higher interest rates, which allowed it to lift its net interest margins from 1.58% to 1.71% in the 6 months. And this was mainly driven really by by them lifting their lending rates faster than the rates that they pay on deposits. So Dan, ANZ did warn of geopolitical uncertainties and also rising interest rates, such as the impact it could have on bad debts and home loan growth. Should we be concerned about the bank's ability to sustain its dividend yield over the near term?
That's a great question, Ken. It's really the question that investors and analysts have on their mind. And if you look at the data, it's suggesting that on average, borrowers are still doing well, with around 70% of mortgage customers ahead of their scheduled repayments. As fixed rate loans begin to roll off into variable rates, the next 6 months will be a little bit more testing. However, from an earnings perspective, Kien, the better than expected net interest margin, as you mentioned, could assist with positive earnings revisions and support dividends in the year ahead. And the stock is trading on an unstretched payout ratio of around 65%, which translates to a gross dividend yield of around 8%.
Yeah, that yield looks very attractive there, Dan. But across to our resources, tin producer and also Star Growth stock, Metals X, they released their first quarter 23 production update, revealing though an 8% decline on year. And that was due to lower grade and higher impurities as well. In addition, you've also got falling tin prices and a lack of analysts covering the stock. So investors here, should they be concerned about this stock?
That's a great question, Ken. There's no doubt the company has had some troubles. If you just look at the share price, it'd be quite obvious. And it's also important to remember that mining can be a seasonal business, as production is typically impacted by many variables. Some of those include weather, labor availability, equipment disruptions, and all of these things can lead to production chopping and changing from quarter to quarter. In that sense, a down quarter is not a call for immediate concern. And importantly, management have stated that production should improve in the next quarter, with the number of processing reconfigurations and some blending programs to improve both recoveries and throughput. They also believe tin prices should start to revert to around the US $25,000 a tonne level from current levels from around $19,000 to $18,000 a tonne, which should provide some support.
Yeah, but commodity prices are very difficult to predict, and investors should only look at this stock if they are comfortable with the risks. But the drastic fall in the tin prices over the last few months means that it could impact its return on invested capital. So there is a high chance that Metals X may not meet Lincoln's growth criteria at its upcoming report in February.
That's right, Kien. And now moving on to the corporate calendar. For the week ahead, Borderline Star Growth Stock CSR is expected to report its interim results on the 4th of November, and Star Income Stock Westpac should go ex-dividend on the same day. We also have some companies coming out with their AGMs, and those include DDH1, Waypoint REIT, AUB Group, and a few others.
For Under the Microscope this week, we look at Australia's biggest private health insurer, an ex-Star income stock, Medibank. Now, following the Optus data breach, Medibank has fallen victim to a cyber attack, which has led to the personal data theft across its entire membership base. Management did downplay the hack 2 weeks ago, telling the market that there was no evidence of this, adding that it did not expect a material impact on its financials. So, Dan, does this latest announcement undermine the credibility of management?
Well, Kien, it really appeared as if management didn't comprehend the magnitude of the problem when it received threats from the hackers, and that was quite disappointing. However, they should have erred on the side of caution instead of playing it down and trying to avoid public scrutiny. This has significantly undermined the credibility of its leadership and the reputation of what is an iconic brand.
Yeah, that's right. To date, Medibank has still not confirmed the full extent of the data breach, but we do understand that it could potentially affect all members. Now, immediately, the business needs to provide support and reimbursement to their members, and this is expected to cost around 25 million to 35 million, meaning that earnings expectations could potentially fall by up to 10%. And although there seems to be some buffer with the payout ratio at 84%, there are other issues also impacting the business, especially the dividend outlook, right?
Yeah, that's absolutely correct, Kien. And not only will this incident create near-term churn in the number of policyholders, but the flag cost estimate doesn't include expenses for further data security investment, remediation, and regulatory or litigation-related costs, which could all be substantial and place significant pressure on Medibank's near-term earnings and dividends. This is why the share price nosedived by around 18% on the day of the announcement. Also be mindful of the discounted valuation, as share price would be subject to downward revisions by analysts over the next few days.
And although the company is trading on an attractive forward gross dividend yield of around 7.7%, that's mainly driven by the rapid fall in its share price, but there's also that ongoing uncertainty to earnings, plus, of course, the loss of management credibility. It means that that dividend remains at risk. As such, we've decided to remove the stock from coverage, plus the company isn't expected to go ex-dividend until March next year. So there is plenty of time to reassess these risks, especially following its first half report in February. The Australian federal budget for 2022 was released this week, and from our perspective, it appears Treasurer Jim Chalmers is exercising fiscal discipline with no free handouts and a moderate increase in the budget deficit between financial year 22 and 23. And this would make the RBA's job of tackling inflation easier, as fiscal largesse could have stoked inflationary concerns. Of course, an in-depth analysis of the budget is beyond the scope of today's episode. But Dan, how would this budget impact some of our star stocks?
Certainly can. And broadly speaking, as you mentioned, the winners from this budget were new parents, families, those looking to buy a home, and electric vehicle buyers. New parents will benefit from a more extended parental leave payment from 20 weeks to 26 weeks, and families will see cost of childcare decrease as subsidies are lifted. And this should benefit childcare REITs such as Arena REIT and also Charter Hall Social Infrastructure REIT. There was also a drive towards green energy, with hydrogen fuel cell and plug-in hybrid cars to be exempt from taxes if their retail price is below the luxury car tax threshold. While the benefit is not immediate, it should support companies such as car sales and also battery metal miners such as IGO and Allkeen, and also Linus.
And let's not forget, the government also wants to encourage the construction of 1 million new homes over the next 5 years, which should positively impact stocks like REA and construction material companies like James Hardie and CSR. Okay, that's all we have time for today, Dan, and thanks for your contributions.
Thanks, Ken. It was great to be back and speaking to our members yet again.
Yeah, and next week we do have the Melbourne Cup holiday on Tuesday in Melbourne, but we'll be available to help answer your questions, especially on Lincoln Live on Monday. So stay tuned for that. To summarize, really, inflation continues to spook markets and could potentially put pressure on our star growth stocks and those quality stocks. But the AGM season has shown that earnings and dividends for most of these businesses remain resilient, and of course, perhaps presenting great opportunities for investors. Take care and have a happy, healthy, and prosperous week, everyone.